Good morning children. Welcome to Accountancy Digital class. Today in this class we are going to see about admission of a partner. Under admission of partner we are going to see about adjustment for goodwill. At the time of admission of a partner, an existing partner sacrifices part of the share of profits in favor of the new partner. Hence, to compensate the sacrifice made by the existing partners, goodwill of the firm has to be valued and adjusted. In addition to capital, the new partner may contribute towards goodwill. This goodwill is distributed in the sacrificing ratio to the old partners who sacrifice. Now we will see the accounting treatment for goodwill. When new partners bring cash towards goodwill, when the new partner does not bring goodwill in cash or in kind, when the new partner brings only a part of the goodwill in cash or in kind, existing goodwill. Amuda and Bhuwana are partners who share profits and losses in the ratio of 5:3. Chitra joins the firm on 1st January 2019 for 3/8 share of profits and brings in cash for her share of goodwill of Rs 8,000. Pass necessary journal entry for adjusting goodwill on the assumption that the fluctuating capital method is followed and the partners withdraw the entire amount of the share of goodwill. Children, here in this sum, as the sacrifice made by the existing partners is not mentioned, so it is assumed that they sacrifice in their old profit sharing ratio 5:3. So therefore now the sacrificing ratio is 5:3. The first journal entry is for the cash brought for goodwill. So that has to be credited to the old partner's capital account in the sacrificing ratio. So for receiving cash, bank account debit to Amuda's capital account to Bhuwana's capital account. Here they have not given the sacrifice ratio, so it is assumed that the old profit sharing ratio is taken as sacrificing ratio 5:3. So 8,000 has to be distributed among Amuda and Bhuwana in the ratio of 5:3. So Amuda's capital account 8,000 into 5/8, 5,000, to Bhuwana's capital account 3,000, 3/8, 3,000. So cash brought for goodwill credited to Amuda and Bhuwana in sacrificing ratio. So in the sum it is given that it was withdrawn by the partners. So journal entry for withdrawing the amount by the partners. Amuda's capital account debit 5,000, Bhuwana's capital account debit 3,000 to bank account 8,000. Amount withdrawn by the partners. Now the next problem is Arun, Babu and Charles. They are partners sharing profits and losses equally. They admit Durai into partnership for 1/4 share in future profits. The goodwill of the firm is valued at Rs 36,000 and Durai brought cash for his share of goodwill. The existing partners withdraw half of the amount of the share of goodwills. Pass necessary journal entries on the assumption that the fluctuating capital method is followed. Children, here Durai's share of goodwill is 1/4 share in future profits and the value of goodwill is given as in the firm it is 36,000. So 36,000 into 1/4 is Rs 9,000. Here also in this sum they have not given the sacrificing ratio. So the old profit sharing ratio has to be taken as sacrificing ratio. Look at the sum. Arun, Babu and Charles are partners sharing profits and losses equally. So it is assumed that the old profit sharing ratio is 1:1:1. So therefore the sacrifice ratio is also 1:1:1. So now the first journal entry is for cash brought for goodwill. It should be credited to old partner's capital account in sacrificing ratio. So bank account debit 9,000 and the sacrificing ratio is 1:1:1. So Arun's capital 3,000, Babu's capital account 3,000 and Charles' capital account 3,000. And then the cash withdrawn by the partners. Here only half of the cash is withdrawn by the partners. So 9,000, in that half is 4,500. Arun's capital account debit 1,500, Babu's capital account 1,500, Charles' capital account debit 1,500. Now the next problem is Aravind and Balaji are partners sharing profits and losses in the ratio 3:2. They admit Anirudh into partnership. So now the new profit sharing ratio is 1:1:1. Anirudh's share of goodwill is valued at rupees 20,000, of which he pays rupees 12,000 in cash. So children, you have to pass necessary journal entries for goodwill on the assumption that the fluctuating capital method is followed. So now we will calculate the sacrificing ratio. Sacrificing ratio is equal to old share minus new share. So the old share is 3:2. So now for Aravind, 3/5 minus 1/3. New profit sharing ratio is 1:1:1. So after taking LCM, it comes to 4/15. And for Balaji, it is 2/5 minus 1/3. So it comes to 1/15. Now the sacrificing ratio is 4:1. So now the journal entry is cash account debit. He is bringing 12,000 as cash and Anirudh's capital account 8,000 to Aravind's capital account to Balaji capital account 4/5 1/5. So that comes to 16,000 4,000. So share of goodwill of Anirudh credited to old partner's capital account. Now the next problem is Satish and Sudan are partners in a firm sharing profits and losses in the ratio of 4:3. On 1st April 2018, they admitted Sasi as a partner. On the date of Sasi's admission, goodwill appeared in the books of the firm at rupees 35,000. By assuming fluctuating capital method, pass necessary journal entry. If the partners decided to write off the entire amount of existing goodwill, write off rupees 21,000 of the existing goodwill. Now the first journal entry is to write off the entire existing goodwill. So Satish capital account debit, Sudan's capital account debit to goodwill, and it is shared in the ratio of 4:3. So 20,000, 15,000, that comes to 35,000. And the next journal entry to write off 21,000 of the existing goodwill. So Satish capital account 21,000 into 4/7, 12,000. Sudan's capital account 21,000 into 3/7, 9,000. To goodwill 21,000. Existing goodwill written off to the extent of rupees 21,000. Vetri and Ranjit are partners sharing profits in the ratio 3:2. Their balance sheet as on 31st December 2017 is as follows. All the assets on the asset side and the liabilities on the liability side. Furniture, stock, debtors, cash in hand, profit and loss account. That's a loss of 10,000. Here capital accounts of Vetri and Ranjit 30,000, 20,000. Reserve fund 5,000. Sundry creditors 45,000. On 1/1/2018, they admit Surya into their firm as a partner of the following arrangements. Surya brings 10,000 as capital for 1/4 share of profit. Stock to be depreciated by 10%. Debtors to be revalued at rupees 7,500. Furniture to be revalued at rupees 40,000. There is an outstanding wages of rupees 4,500 not yet recorded. Children, here you have to prepare revaluation account, partner's capital account and balance sheet of the firm. So now we have to prepare the revaluation account. Stock is to be depreciated by 10% and the value of stock is rupees 20,000, and in the 10% comes to 2,000. So there is a decrease in the value of an asset to stock account 2,000. And the next one is debtors is to be revalued by 7,500. So the difference comes to 2,500 to debtors account. Furniture is to be revalued at rupees 40,000 and the book value of the furniture is rupees 25,000. So there is an increase in the value of an asset by furniture account 15,000, and there is an unrecorded liability to outstanding wages 4,500. Now the difference comes to 6,000, that is shared among Betty and Ranjit in the ratio of 3:5. So Betty's capital account is 3,600 and Ranjit is 2,400. Now we have to prepare the capital account. Capital account, write the format, write all the partners' name, Betty, Ranjit and Surya. By balance brought down, it's from the balance sheet 30,000 and 20,000, it's for Betty and Ranjit. And reserve fund account has to be allocated to Betty and Ranjit, so that comes to 3,000 and 2,000. And revaluation account 3,600, 2,400. By bank account, because Surya has brought capital, so by bank account 10,000. And there is a profit and loss. Betty and Ranjit 6,000 and 4,000. Now the difference comes to 30,600, 20,400 and 10,000. So now the balance brought down is 30,600, 20,400 and 10,000. Children, now we have to prepare the balance sheet. Liabilities, assets. Furniture, the book value is 25,000 and add appreciation, there is an increase of rupees 15,000. So that comes to 40,000. Stock 20,000 and the depreciation is 2,000. So less depreciation 18,000. And debtors 10,000, less decrease 2,500, 7,500. Cash in hand 35,000. And in that you have to add Surya's capital account because he has brought cash. So that comes to 45,000. Now the capital account is, for Betty we have calculated as 30,600, for Ranjit 20,400 and for Surya it is 10,000. Sundry creditors 45,000 and outstanding wages 4,500. So now the total of the balance sheet comes to 1,10,500. Children, this is your homework problems. You have to do it in your accountancy classwork. Thank you, children. Have a nice day.